Hi, and welcome back again to Tim Bigham's Big Time Options, Edges and Hedges. Taking a look at SanDisk today, SNDK. We're an overvalued, overbought, and overly rich option sets up ideally for a sell strangle trade. And as always, we like to take that fusion approach looking at fundamental, technical, and IV analysis. So let's jump in and take a look. First, on the fundamental front, here is price to sales. SanDisk finally had earnings, right? So PE is actually evident for one quarter, right? And they beat very nicely, but still very expensive stock, as you can see, price to sales at the highest levels we have seen basically ever. You can see here on a one-year chart, softened a little bit post earnings, but the stock continues to rip higher. Longer term, absolutely at extremes. Price to sales at over 11x. 5 and 3 year average were around 5, so we're looking at basically 2 times the normal valuation metrics, which probably is the reason that the analysts have a lower price target than the current stock price, right? Highest one is only 1,000, so certainly SanDisk getting a little bit overdone on the fundamental front. On the technical front, you can see the stock definitely overbought. 9-day RSI back over 90, MACD at the highest level of the past year. Bollinger percent B over 100. IV, as you can see, and we'll take a closer look in a second, really hasn't pulled back even after earnings, which beat nicely, right? But the stock has ripped higher. But we finally saw some sort of pushback on Tuesday, right? That doji pattern where the stock traded higher, opened, went higher, reversed, and closed basically unchanged on the day. Doji pattern many times a sign that the previous trend may be exhausted, right? And you can also see the last time implied volatility, which we'll take a look at next, was this elevated, led to a pullback in the stock. And we can see from an IV perspective, IV certainly back to extremes here, over 100 on a 360-day basis. Here was the last earnings, right, where you saw the normal kind of pump and then vol crush, right? We did see here was the last earnings, a little bit of that, but now we're back higher and approaching the highest levels in essence ever on SanDisk long-term and generally every, vol surface expiration term, right? So IV getting to extremes as well. So we love to take advantage of that, especially longer term when you get to these extremes as far as structuring a trade. You can see here's another look at IV from a different perspective. Here was that kind of small pullback post earnings and a rip higher. IV now much higher than even previously before earnings. You can see from Monday to Tuesday, IV moves sharply higher, long end up about 3%. So that's set up ideally, right, for a trade to go about capturing that overbought stock, overvalued with very rich options, going out selling the January 28th expiration, so going out to 2028, selling the $1,000 call, the $500 put. It was priced just around $495 on the close rate. You can see the upside break even would be the price of the strangle, $495, plus the short strike price of 1,000, or $1495 with the stock roughly around 700. You'd have to have the stock go up more than 100% from where it is now after this rip-roaring red-hot rally to get in trouble naively on the trade. Downside break even, literally no downside. You have 5 points of downside because you're bringing in 495 and the 500 put is your short strike price. So certainly don't mind having the stock pull back here. And it sets up bearishly, believe it or not. So a negative 68 by selling the calls, right? And then by selling the put, you're positive 17. So you'd end up about 50 deltas net short, believe it or not, even though the calls are roughly 300 points out of the money and the puts 200 points because of the upward drift and the high IV. It sets up as a bearish trade. So you can see theoreticals, if we take a look at that, I simply pulled off, moving it from where it was on the close at that almost 100 IV, pushing it back towards just a 90. So we're not looking for a big, return here. We're just looking for a pullback of some sorts back to around this level here. A slight pullback would put the theoreticals then on that sell strangle, put the price back to 445, and we're selling it for 495. So you'd pick up about 5 grand. As you can see here, if we take a look at the individuals, the call theo by dropping the IV from 96.71 to 90 would be $23.80 cheaper just by having the IV drop from 96 and change to 90, from where it's at now to 90, right? The put's the same way, dropping it from just under 100 to 90, you'd pick up about 21 points on the put, so you'd pick up that 45-point gain on the trade. And notice too that just having the IV drop makes that call delta actually lower, the put delta a little bit higher, so you become a little less bearish, if you will. So I took a look at doing the trade right. It would tie up about $7,000 in margin to sell one of these strangles. And if you do get that reversion and you can make somewhere around 5,000, you'd have a very nice return on risk. So that's how we go about identifying opportunities. We absolutely love this long-term trade with extremes of implied volatility, right? We like to go out far in time, right? Doesn't mean we're going to hold it, right? Kind of like the silver trade that we held for basically 1 day in one case and 1 week in the other one. Doesn't, even though we traded the 2028, doesn't mean you have to hold it till expiration. So hopefully provides insight into how we go about identifying opportunities, structuring the trades. But at the end of the day, as we always like to say, trading is about probability, not certainty. So make sure you position size appropriately, and make sure that when you get to the risk level, the losses that make you uncomfortable, you at least close out some, if not all, the trade. So until next time, as always, here's the good trade.